All right, today we're diving deep into a company called Performance Food Group, or PFGC. And let me tell you, this food service giant is at a critical turning point. They are making a massive bet that could either crown them the new king of the industry or, well, bury them in a mountain of debt. For any investor, this is a story you've got to pay attention to.
So what's all the noise about? Well, how about a potential merger that would create a nearly $100 billion behemoth? And at the same time, an activist investor who just forced his way onto the board to make sure things go his way. Yeah, this is a company in serious motion. And believe me, the stakes could not be higher.
Okay, so let's get right into it. To really understand what's happening, we need to look at two huge events that have shoved PFGC right into the Wall Street spotlight. And the crazy part? It all happened in the span of just 1 month.
I mean, just look at how fast this all went down. We're talking 3 weeks. In 3 weeks, PFGC went from business as usual to having an activist investor on its board while publicly talking about a merger with its biggest rival. This completely changes the game for the company and for anyone invested in it.
Now you might be asking, why is all this happening now? To get that, we need to pop the hood and look at the company's core strategy. You see, for years, they've been running a very specific and very aggressive playbook.
It really comes down to this two-pronged attack. First, they just buy growth. They're constantly gobbling up other companies to expand their map. Second, they fight tooth and nail for organic growth, and they do that by zeroing in on independent restaurants. And you know what? It's been working. They've been slowly but surely stealing market share from the longtime industry champ, Sysco.
And this right here, this is their secret sauce. See, independent restaurants are the most profitable customers in the entire business. And the data shows that while their rival Sysco has been kind of dropping the ball here, PFGC has been swooping in and winning over these incredibly valuable accounts.
But, and you knew there was a but coming, this aggressive growth strategy has a pretty steep price tag. For investors, this is where it gets really interesting, because you have to look at two totally different profit numbers that tell two completely different stories.
First up, you've got the number that management absolutely loves to talk about. It's called Adjusted EBITDA, and it was up an incredible 17.3% last year. On the surface, this looks like a super healthy, fast-growing business. But that's not the whole picture.
Because then you look at the official by-the-book number, what's called GAAP net income, and the story completely flips on its head. It actually went down by 22%. So what on earth is going on? How can one profit number be soaring while the other one is tanking?
Well, the puzzle gets solved when you see what each number includes. That adjusted number conveniently leaves out a lot of the cost from their acquisition spree. The official GAAP number, on the other hand, includes all the real-world costs, like the huge interest payments on the debt they took on to buy all those companies. So yeah, the core business is doing okay, but the costs of buying all that growth is seriously weighing down the actual bottom line. So with this kind of complicated financial picture, how does PFGC really stack up against the competition? To get the full investment story, you have to see where they fit in the food chain. And this chart just lays it all out. Sysco has been the king for a long, long time. PFGC is the clear number 2, and US Foods is number 3. But just look at those revenues. If PFGC and US Foods merge, you're looking at a nearly $100 billion giant that would jump over Sysco to become the brand new market leader. You can see why this is so tempting.
And when you look just at raw growth, it's not even a contest. PFGC is growing its sales more than twice as fast as Sysco. This is the growth story that gets investors excited and willing to pay a higher price for the stock.
But here's the trade-off laid bare. For every single dollar in sales, Sysco is almost twice as profitable as PFGC. This is the cost of that buy-at-all-costs growth strategy. PFGC is growing way faster, sure, but it's much, much less efficient at turning those sales into actual profit.
And for an investor, this chart right here, this might be the most important one of all. It's called return on invested capital. Basically, for every dollar you put into the business, how much does the business generate in profit? And here, the difference is just wild. Sysco generates a fantastic 17.6% return. PFGC is under 5%. It shows that PFGC has gotten really good at buying companies, but it hasn't proven it's very good at making those purchases profitable yet.
So what does this all add up to? You take the fast growth, you mix in the low profits, and you sprinkle in the potential for a mega merger, and what do you get? You get a classic bull versus bear debate for any potential investor.
The bull case is really a bet on momentum.
It's the belief that PFGC can keep this train rolling, make their acquisitions work, and, most importantly, get that game-changing merger with US Foods approved. The bear case is a bet on reality setting in. The fear that Sysco will fight back hard, that the debt load will become too heavy, and that regulators will say no way to the merger, just like they did to a similar deal back in 2015.
So if you're following this story, these are the vital signs you need to watch. Is their growth in that key independent restaurant segment still strong? Are those profit margins starting to get better? Is that debt level staying under control? Is that all-important ROIC number finally starting to climb? And of course the big one, any news out of Washington, D.C. on that merger?
At the end of the day, it all comes down to this one huge question. Performance Food Group is pushing all its chips to the center of the table in a high-stakes bet on growth. If they pull it off, they could become the top dog in a trillion-dollar industry. But if they fail, they could just be left with a much bigger, more complicated business buried under a mountain of debt. The game is officially on.